The modern financial market is a relentless, violent stream of raw data that demands immediate and precise human reactions. Navigating this chaos requires a reliable filter. Traders need indicators to strip away the noise and identify genuine market trends. For decades, the average directional index, or ADX, has served as the universally accepted textbook standard for measuring that trend strength. Every retail trader learns the rule: wait for the ADX to cross above the 25 threshold before buying. They execute a buy order the very second the line crosses 25. The price instantly stalls, then violently crashes downward, stopping the trader out. This specific loss was the inevitable result of the indicator's internal mathematical architecture. There is a specific reason why a tool designed to confirm strong trends seems to routinely signal the exact top of a market rally. This delay is a hard-coded, structural property of the algorithm itself. The ADX calculates its values using a default 14-period setting. That look-back window creates a massive time gap between actual real-time price momentum and indicator confirmation. Modern execution happens in nanoseconds, yet traders are filtering those decisions through 1970s-era mathematical smoothing. Using the ADX as a localized entry trigger systematically forces you to buy into the tail end of an established move. To understand why this delay exists, we have to look back to 1978. J. Wellis Wilder originally designed the system not for high-frequency algorithmic trading, but for daily commodity markets. In the physical reality of a 1970s trading floor, filtering out extreme daily price noise was a basic necessity for survival. Wilder needed to build a system that measured pure directional behavior while entirely ignoring random daily volatility spikes. His invention, the Directional Movement Indicator System, proved so effective for its time that it remains hard-coded into every professional trading terminal today. The true indicator is a complex matrix of interacting lines: the positive directional indicator, the negative directional indicator, and the ADX itself. To understand why the modern trade failed, we must manually unpack these overlapping lines and deconstruct the underlying math step by step. Let's dissect the anatomy of this delay. Step 1. The system calculates raw directional movement by measuring expansion between highs. Step 2. To remove noise, this data is smoothed through a 14-period moving average to create the DI lines. At this exact stage, we have already introduced one massive layer of mathematical lag into our data stream. Step 3. The ADX line is created by taking the absolute difference between those two DI lines and smoothing it again through another moving average. The ADX is a double-smooth derivative of price. By design, it is blind to real-time reality. Look at the exact physical distance between when the price actually started trending upward and when the bottom ADX line finally crossed 25. This gap represents 14 to 28 periods of active market movement that the indicator completely missed. During this specific lag window, the psychology of the market is shifting. Early buyers who recognize the initial momentum have already secured massive gains. This triggers a phase known as trend exhaustion. Early participants begin taking profits, leaving only late retail entrants to chase the fading momentum. The mathematical delay of the ADX calculation perfectly aligns with the psychological exhaustion of the market participants. By the time the ADX line finally crosses 25, the trend has typically entered its most vulnerable, aged state. Does this structural lag render the ADX useless for modern traders? No. It remains highly valuable, provided you stop using it as a micro-trigger and reclassify it as a strategic macro filter. Traders must zoom out to higher timeframes to use smoothing as an advantage. This establishes regime rules. When macro ADX is below 20, the environment is range-bound, dictating mean reversion strategies. When it sustains above 25, it's trending, permitting trend-following strategies. The ADX's true utility is simply telling you what kind of battlefield you are standing on, not when to fire your weapon. Once the macro ADX permits a trend-following strategy, you must completely abandon lagging indicators for the actual trade entry. Localized execution must rely purely on unsmoothed, zero-latency data, such as raw price structure breakouts or sudden shifts in volume delta. Never use a double-smoothed indicator to time a volatile market. Use the ADX to map the terrain, and rely purely on price to pull the trigger.